In this presentation, we will take a look at pension trust funds, recalling that pension trust funds are going to be a fiduciary type of funds, recalling that there are three major groupings of funds, those being the governmental type funds, the largest group, the proprietary type funds, those are going to be similar in some ways, in some nature to for-profit organizations, and then the fiduciary type funds, those where there's going to be some type of fiduciary responsibility, of which the pension trust fund is one, and that is where we're focusing on here. Pension trust fund, fiduciary fund. Pension trust funds reports pension liabilities and expenses under the economic resources measurement focus. This provides a broader perspective of employers' net position than a fund-based approach that focuses only on employer contributions and progress towards funding benchmarks. So note that the pension fund may differ a little bit than other types of funds because we're going to provide that broader perspective within the pension funds. Note that as we think about pension funds, of course, they're going to could be quite complex, and they're going to be somewhat of a specialty in and of themselves. We'll discuss the different components and their overarching rules related to the types of pension funds. The two broad categories of pension plans include the defined contribution types and the defined benefit type. So these are going to be the broad types of categories, the two types of pension plans that can be set up. When we consider the defined contribution plan, the amount or rate of contribution is specified. Benefits payable depend on contributions made and performance of the members' accounts. This would be a more of a straightforward type of plan, or an easier type of plan to account for, one would think, most of the time, because you're thinking about this is going to be based on how much of the contribution is going to be put into a specific plan. So we can imagine a specific plan. We can imagine an employer setting up, in essence, some type of investment account, a defined contribution type plan, and then determining how much they're going to contribute to the plan. And then we're going to think about how much the growth of the plan will be, depending on how much we as the employee would put into the plan, as well as how much growth there is in the plan, and possibly some type of employer matching into the plan. That's going to determine what the benefits will be at the end of the plan, at the point of retirement. That's going to be a little bit more easy for us to calculate, because we can have an estimate of what's going to go into the plan, and then we can have some estimate of growth, which is more difficult, of course, to think about the growth will be, and base the benefit calculations on what's going to be paid out at the end. Then we have another type of plan, which is the defined benefits plan. Within the defined benefits plan, the amount of the benefits are specified, and then we think about the contributions, which are going to be based on actuarial calculations, so that the funding of future benefits is enough. So this is a bit more complicated for us to kind of speculate on what the type of contribution will be, because we're going to be using, as you can see here, actuarial calculations in order to figure what the contributions should be, because you'll note that the focus here then is on the amount of benefits to be specified. So we're then going to start with the amount of benefits. We're going to say, hey, these are the benefits that are defined, as opposed to the defined contribution plan, where the benefits are dependent on how much was put into the plan and the performance of the plan. Here we're going to say the benefits are fixed. We're going to commit to the benefits and say, hey, we're going to, no matter what happens, this is basically what the benefits are. Then we need to then go back and say, well, how can we then figure out what the contributions should be in order for us to be able to meet those obligations that we've set up? In order to do that, we've got to have the contributions based on actuarial calculations. So we think about actuarial calculations. You could think of those about statistics, how long will people live on average type of calculations, in order to figure out the proper type of contributions for the benefits, the fixed amount, to come out correctly. Defined benefit plans could be the single employer pension plan, or we could have multiple employer pension plans. Now note, when you think about the defined benefit plans, because we have actuarial type of calculations, because the benefits are defined and we have to kind of think about what the amount of the contributions could be, it may be easier in some cases to have a larger type of pool. So that's why we might think about having multiple employer pension plans that would then have agents that are going to act as helping us out with, basically, in essence, the pension plan to help out with the actuarial type of calculations. If we think about the defined pension type of plan, then we have averages going into play here, because if we have a lot of different people that are into the one plan, the actuarial type of calculations are going to make more sense. So if we're thinking about how much will the plan benefits be, we have to think about how long someone's going to live. we could think about averages, which a large pool of people, if there's a large pool of people, we could think about averages and make that calculation a little bit more easily. If we're thinking about just a small group of people and we're trying to apply averages to them, then the small group of people can be way outside of an average that might be given in an average, like an actuarial type of table or calculation would provide. So if we have an actuarial calculation, larger group of people, you would think then that the average would be correct, although we're going to have those outliers that will happen. And therefore, sometimes grouping more employees together when we think about the defined benefit plan might be a more reasonable way to go in some cases. Required reporting for defined benefit pension plans. So the required reporting would be, and note when you're thinking about governmental type plans, often the defined benefit plan is often the type of plan that's going to be there. It's often thought to be more of a benefit to the employees in some ways because it's going to be more determined in terms of what your retirement will be. It's not as determined on market conditions and whatnot because the commitment is there. This is what your benefit is. It, as opposed to if we have a contribution plan, then if the market goes up or down, the benefits could differ. And if you live longer than you would expect, then you may not have planned for that as well. Whereas a defined benefit plan is thought to be better in some cases for the employee, at least to have that security to be able to say, hey, this is how much it's going to be until you die. So that's why a lot of the government plans could have that defined benefit type of plan, which is thought to be a benefit oftentimes. So the required reporting for defined benefit pension plan: statement of fiduciary net position, statement of changes in fiduciary net position. So obviously the statement of fiduciary net position is going to be similar to the balance sheet type of account position where you're at a specific time. Statement of changes in fiduciary net position, that's going to be the changes over time. So that's going to be more like an income statement, timing type of account. Detailed notes to the financial statements and required supplementary information. Employer's pension accounting. Employer pension related expenses, expenditures, deferred outflows of resources, applicable liabilities, and deferred inflows of resources are recorded within fund and government-wide financial statements. So within the fund and the government-wide financial statements, measures that need to be calculated and reported are the net pensions liability and pension expense or expenditure. Key calculations then here being the net pension liabilities and the pension expense or expenditures that need to be reported. What is then the net pension liability? Key calculation: net pension liability. Net pension liability is employer's unfunded pension liability, the difference between the total pension liability and the amount of fiduciary net position held for future pension payments. Keywords there being the unfunded pension liability. So unfunded pension liability, what does that mean? It's the difference between the total pension liability, so the total pension liability that we have, and the amount of fiduciary net position. We're talking about basically the balance sheet net position, equity section, assets minus liabilities, fiduciary net position held for future pension payments. Total pension liability is the portion of the present value of projected benefit payments to be provided through the pension plan to current active and inactive employees. So the total pension liability, another key term, total pension liability is the portion of the present value of projected benefits payments to be provided through the pension plan to current active and inactive employees. That's what the liability is, of course, what's going to be paid out to the active employees and the inactive employees if there's something in the pension plan that we need to pay off in basically retirement sometime in the future. Attributed to these employees' past periods of service based on actuarial valuations generally required to be performed at least every 2 years. So in order to think about benefit plans in the future, we have to have the actuarial calculations in order to project what the obligations will be. We're going to have those actuarial calculations at least every 2 years, typically. Then the other key term is being the pension expenditures. So pension expenditures, amount paid by the employer to the pension plan and the changes between the beginning and ending balances of amounts normally expected to be liquidated within expendable available financial resources. go through a calculation here. We're not going to spend a lot of time on the calculation, but this will give us an idea of the calculation. We have the service cost, actuarially determined benefits related to the current year, plus the interest on total pension liabilities, plus or minus plan changes recognized immediately, plus or minus changes in fiduciary net position from other than investments, admin expenses, member contributions, minus projected earnings on plan investments, plus or minus recognition of portion of deferred inflow and outflow. That is going to give us the pension expense for the period.